Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. And I was looking through the comment section. I know I talk a lot about ratios, ratio investing, identifying value. And I know I'm kind of beating this, there's a lot of new people on the channel who don't know what ratio investing is. I am a guy that made quite a bit of wealth through ratio investing only physical precious metal holdings. Now, I know there's a lot of questions. What is ratio investing? How do you do it? I have this presentation. I've given this presentation before. I'll do it again to get it in front of you so you guys know what it is, how to do it, what to look for. I'll even talk about my experiences of swapping metals. Now, I don't swap metals very often. This is only when anomalies present themselves in history. And I can show you sometimes, I'll do a clip on when I swap my metals and why I did it. But here, this is ratio investing. This is the basic underlying fundamental reasons of why you want to swap between assets, between physical metals, to increase your purchasing power gains over time. Now, this one is an extreme because I used all the metals. I used rhodium, palladium, platinum, gold, and silver. I used them all. And I'll show you the returns that you can get if you know what to look for. So let's jump in, do some ratio investing. I'm going to show you and tell you what it is. So ratio investing. So what we're going to do is we're going to use ratios. Let me back up one last time. What we're going to do is we're going to use ratios and we're going to use physical precious metals. We're going to buy a physical precious metal. We're going to swap it to something else when the ratio tells us. Now, there is some frictional costs doing the swap at your dealer. He has to make some money. So there's a small frictional cost. This scenario is a hypothetical scenario so you guys understand the underlying way of how it works. And there's no frictional cost there. So keep that in mind because you are going to give them some metal. And sometimes you get overspot, sometimes you don't. Depends what the supply demand balance is of that metal. And then you're going to swap. And usually it's good because you have the metal that's overvalued that people want. And then you're going to buy something that's cheap. So usually what happens is you can go into a dealer and you can bargain with them. And you can say, I'll bargain with you. I'll give you this metal if you give me this metal for this price. Or they'll give you a price and you can kind of haggle them down because you're giving them a metal that everybody's buying because it's, quote, in favor, and you're buying a metal that is out of favor, that nobody wants. That's the positive. And if you're buying something that's cheap, usually the premiums are really low too. So it's like this double positive. So let's get into the scenario here. So we've got $10,000. That's the scenario. It's in the year 2000. That's just because it's the year after I graduated college or high school. I just chose 2000. It was 20 years at the time. So it's 2020. We're doing this for 20 years, this analysis, and we're starting in the year 2000. I'm going to use all 5 metals: gold, silver, platinum, palladium, and rhodium. Whatever the ratio tells me to buy, I'm going to buy it. We're showing buy points and ounces as we walk through this example. So I'm going to show you what I would buy, why I would buy it, and I'll show you the ratios and the charts that I'm looking at, exactly what I would do today. So I'm looking at these charts. This is in, remember, the year 2000. That's where those red circles are at. And we're looking to see what the cheapest metal is because we just arbitrarily chose 2000. So if you look, rhodium to platinum ratio, that's not a good ratio for rhodium. It's a good ratio for platinum. So platinum's cheap here. Platinum to palladium ratio, we're low right here. So platinum is cheap in comparison to palladium. So we want platinum. So for this chart, platinum's cheap. For this chart, platinum's cheap. For the platinum to silver ratio, if you look at this, I would say that silver's cheap in relationship to platinum. And the gold to silver ratio, silver is on the cheaper side for the gold to silver ratio. So in this scenario, I would buy silver at this point. So in the year 2000, silver is cheap based off of the ratios. I'm going to deploy the $10,000 into silver. It's a $5 average price in the year 2000. So 10,000 divided by 5 is 2,000 ounces of silver. 2,000 and 2,000 for silver. So we're going to watch the ratios. We're going to look at the charts and we're going to see when we hit bottoms and anomalies. So a few years out, in 2003, we hit a bottom here. And the bottom coming down and ready to turn back up, that's where I like to buy things. I like to see a broken downtrend where things break and are about to turn. So our rhodium to silver ratio is flashing that rhodium is cheap. And then we see that rhodium's cheap to platinum, rhodium's cheap to palladium, and rhodium is cheap to gold. So rhodium is cheap to all the metals. And we're holding silver. So silver is cheap to rhodium. We want to swap our silver to rhodium. Now, this is about 100-to-1 ratio, maybe 90. I think it's 97 is the actual ratio here. So we swap our silver to rhodium. The ratio is 97 ounces of silver to 1 ounce of rhodium. So 2,000 divided by, we have 2,000 ounces of silver. We divide it by 97, we have 21 ounces of rhodium roughly. So we own rhodium in 2003. We are continuing to monitor the charts. And we notice that rhodium gets expensive against other assets. Rhodium's expensive against silver, it's expensive against palladium, it's expensive against platinum, and it's expensive against gold. So we want to swap our rhodium, but we don't know what metal to swap into. It's expensive against everything. So we need to do further analysis and look at the other metals like palladium versus platinum, platinum versus gold. We need to look at those types of ratios. So we look at the other ratios, and we've got a gold to palladium ratio. It's kind of in the middle. So that's I would say somewhat cheap palladium. Palladium's definitely cheap to silver. Rhodium to palladium that's obviously cheap for palladium, and platinum to palladium ratio, palladium is cheap to platinum. So palladium is average against gold, but cheap against all the other metals. Palladium is what we want to swap into because it's the cheapest metal. So we swap our rhodium, our 21 ounces of rhodium, into palladium. So we have 21 ounces of rhodium. The ratio is at 1 to 17. So 21 times 17 is 357 ounces of palladium. So now we own 357 ounces of palladium in 2007. So we're 7 years in. We had 2,000 ounces of silver in the beginning. Now we have 357 ounces of palladium. We continue to monitor the ratio charts. And in 2016, something happens. Palladium gets expensive, or palladium gets cheap in relationship to rhodium again. It is dirt cheap. It's way down there. We have platinum to palladium. Palladium is getting expensive in relationship to platinum. Palladium's getting more expensive in relationship to gold. And palladium's getting a little more expensive. It's not too bad against silver, but rhodium is by far the cheapest. So we want to swap it back to rhodium. So we swap our palladium back to rhodium. It is a 1-to-1 relationship. We had 357 ounces of palladium. We now have 357 ounces of rhodium. If you were to go back, we had 21 ounces of rhodium back here. But since we swapped our rhodium for palladium, and palladium did very well, we swap it back to rhodium, we now have 357 ounces of rhodium. That is an incredible increase in your ounces of ownership. Now, let's see what this is price-wise. 20 years of trading precious metals. Just an FYI, we didn't have a single transaction of platinum or gold over this period. It was mainly palladium and rhodium transactions. We have 357 ounces of rhodium, and the dollar amount today would be $5 million from 10,000 in a 20-year period. The return is 38.6% return annualized. So another thing I want to tell you guys, if you do the calculation now, because rhodium is in such a deficit, rhodium is now about $30,000 an ounce. We'll call it $29,000. If you own 357 ounces times 29,000, it's now $10.3 million. Using ratio analysis of swapping metals back and forth, the analysis and the return went from $10,000 to $10.3 million. I just 100x'd. 100. Wait. No. Divided by. I 1,000x'd. That's 1,035 times your money. Over 1,000 times your money. using ratio analysis. So there's other things that you can do to increase your odds of winning here. You want to look at the market balances as well. You want to look to see where are the deficits. Now, we have an opportunity ahead of us. It's called platinum. And let me jump back in here. Now, platinum, if we look at those ratio charts again, remember, these are just averages too. These are averages. This isn't the spikes down. These are averages per year. Platinum to palladium ratio is cheap for platinum. Platinum to gold ratio is cheap for platinum. Platinum to silver ratio is cheap for platinum. Rhodium to platinum ratio, platinum's cheap to rhodium. So by looking at these charts, it is saying that platinum is cheap to all the other metals by a long shot. And in 2020, we were below the cost curves of the high cost producers. Like, that is the lowest risk entry point ever. If you're below the high cost producers, it even got below the medium cost producers. And by you guys being on this channel, you're now getting educated on what to look for. And if you find these opportunities, it's like cheating. It puts the favor in the balance of favor in your favored. How can I say that? That's not said right. You tip the scales favoring you by knowing this information, by knowing the cost curves, by knowing the deficits, by knowing supply-demand balance curves, by knowing ratios. I just put the favor, in my favor by a long shot. And I swap metals for platinum. I bought more platinum. I still own silver. Silver's still a good bet. I own a bunch of silver as well. So my portfolio is like 10% gold, because you got to have some gold. If in a hyperinflation scenario, you got to have some gold. It outperforms in that type of scenario. So I always have gold. I've got silver. It's probably 50%, and then the rest is platinum. In terms of dollar value, at least. I don't know how else you could calculate it. So that's my holdings. Platinum's the play here. It's right there. It's got all the ratios. It's super cheap against all of them. And I've been piling into platinum. I own some platinum mining companies. I own silver as well. Those are my two favorite metals for this commodity bull market from a physical metal standpoint. Now, we got to continue to watch the ratios. We have to continue to look at supply-demand market balances in the future, because palladium is very heavily used as an autocatalyst. If the autocatalyst market somehow declines in the future, that might not be the best metal to swap into, even though the ratio may say it's the best metal. Also, platinum is a substitute for palladium. And rhodium is so expensive that they want to put more platinum or palladium into these catalytic converters to maximize the returns or to reduce the cost of the cars that they sell. So, platinum, I think, is the spot to be. If you guys like this content, give me a thumbs up. Remember, this is just an example, hypothetical example. And thank you for listening. This is Finding Value.